Hi, Bill Bodner, Mortgage Market Guide. Thanks for tuning in to our MMG weekly recap. So rates ticked up a little bit this week. That frenzy on the short covering of meme stocks seemed to have subsided. That coupled with incredible corporate earnings from a lot of the big tech names and big names, pushing stocks to hovering around near all-time highs again. But this is a chart here, which in our eyes has been something we've been talking about each week over and over and over since last summer. And it is the reason why rates continue to move higher. And so this is what they call the break-even rate of inflation. So essentially, this is a chart of where we expect inflation to be for the next 10 years. And so just this week, we are at the highest level in 7 years. And so that's material. And so that means that we're expecting inflation to move higher. At the same time, we're looking at the 2-year note versus the 10-year note, the gap or the spread between those two instruments. And it is now at the widest level in over 3 years. And so that's widening. What does that tell you? A steepening yield curve means we're looking for economic expansion and we're looking for potentially higher inflation. Whereas, an inverted yield curve means we're looking for a recession. So we're looking for the opposite. So we're seeing now a couple of positively sloped metrics, inflation as well as the yield curve. And that means that interest rates are going to be the other one the same way. So, in our eyes, we're watching the 10-year note yield move up to about 115 this week. 118, 119 was the high since goodness last year. And if we take out that level, we're going to be staring at about 130 on the 10-year note, because that was the bottom for many, many years, for a decade, frankly. So that may be some resistance on the way up, but those are technical levels we're looking at on treasuries. And then next week, remember, this is all about inflation. And the reason why these inflation expectations are rising so sharply is because you have incredible stimulus. With this new stimulus plan, that's 1.9 or so that's going to get batted around. We're going to be at $5 trillion in just the last 10 months in stimulus. It's ridiculous. It's incredible. On top of that, you have pent-up demand. You still have a giant portion of the economy hasn't even opened. When those reopen, goodness gracious, the savings rate is like 13% or 14%. It's out of control. Plus, they're getting more checks. So there's a lot of pent-up demand. And then you have this easy Fed monetary policy. And so you combine it all, it just reeks of higher inflation. And so I would, be thinking about that and talking to clients and letting them understand that positively sloped inflation numbers and the yield curve has ramifications to interest rates. Now, next week, another big week. We have more corporate earnings and we have an inflation number. So come Wednesday, we have the CPI coming out. That's a reading on consumer inflation. If that number doesn't meet expectations or it comes in higher or hotter, there could be some concerns. So I hope this finds you well. Have yourself a great weekend. Be safe. Talk to you soon. Bye for now.